Thanks, Anil. Good afternoon, good morning, everybody. Just a recap on the Nedgroup SA Equity Fund. We'll start with just the performance of the fund and the backdrop for over the year to date. So up till June, the fund delivered about 6.7%, ahead of the benchmark of 5.7%. And if we just look at the breakdown of where that came from, if we split our market into the domestic SA shares, you can see that performed quite nicely. The non-resource rand hedges performed reasonably well, and a bit of a softer performance from the resources index. The rand's been pretty stable, and if you look at within the context of in rand terms, we've sort of kept up in line with the emerging markets. But even in rand, you can see how the S&P 500 up 15% in rand year to date to the end of June. So if we just take a snapshot of what the portfolios look like, what the performance has been like, quarter to date, year to date, and longer term. So quarter to date and year to date, pleasing performance ahead of the benchmark in the peer group. We had a challenging year last year, and that underperformance had sort of dragged down our 3 and 5 year numbers, but still ahead if we look at over 3 years, and comfortably ahead if we look at since inception net of fees versus the benchmark as well as the peer groups. Just looking at the way we try to think about the consistency of performance of the fund, if you think about rolling 5-year periods, the fund outperforms the benchmark about 80% of the time, and that's the bottom middle number there in the table below. So we're still about 80% of the time ahead of the benchmark of rolling 5-year periods. If we look at what the fund has performed like since inception, graphically, you can see the cumulative performance. The top line is our fund, the middle line is the benchmark, and the bottom line is the peer group. And you can see how that line has diverged over time with our fund outperforming. Just touching on some of the reasons for the stocks that have delivered the performance. We had a reasonable exposure to SA Inc. stocks, which we topped up during the period. Fushini Group, one of the significant position in the fund, that's performed very nicely. We topped up on First Rand, a reasonable bank exposure in the portfolio. Nedbank also coming through, and we also bought into Remgro as it underperformed earlier in the year. So reasonable exposure to SA Inc., which we felt was cheap, and we can touch on our view post-elections. Definitely a bit more positive environment and outlook for SA shares. And then Anglo Gold had underperformed last year. That came through very nicely. Anglo American also delivered positive performance. If you looked at towards the December last year, they had a capital markets day which disappointed, and the share sold off quite a lot, and we used that as an opportunity to add to our position in Anglo American. They've got a decent exposure to copper, which we think we're very bullish on copper in the longer term. We think there's supply constraint in copper as you need to spend on the green energy transition and electric vehicles, etc., and limited supply coming online, new supply coming online. So very good exposure there to Anglo American, and we could see that justified when BHP's offer for Anglo American, and really we feel that it's the copper portfolio that's attractive within there. Some of the detractors was really quite a number of shares that we didn't own, the likes of Capitec, Harmony, Mr. Price, Truworths, that had performed quite strongly, and that detracted from performance on a relative basis. So if I just touch on how we've positioned the portfolio, a reasonable exposure to the global consumer names that we classify under the global consumer. Naspers and Prosus, we still think that Tencent remains very undervalued, and they're doing the right things in the sense that the growth that they're prioritizing is more profitable, higher margin growth, and you're seeing that coming through quite nicely, which supports earnings growth. The balance sheet's very strong, and they've been doing the buyback, which sort of offsets Naspers and Prosus selling down the share. So Naspers and Prosus, their percentage of Tencent actually reduces quite slowly, given that the buyback that Tencent's doing on that side. So we quite like that, and obviously we're buying Naspers, we're buying Tencent at a 40+% discount through Naspers and Prosus. British American Tobacco, still a core holding in our fund, attractive dividend yield. Richemont, we added to Richemont earlier this year. very resilient jewelry portfolio, the likes of Cartier and Van Cleef. And that makes up about 80% of the profits of Richemont, and they released an update last week, and it also pointed to very strong resilience there. So we think it's reasonably valued at a 20 PE, and if you strip out the cash, that's about an 18 PE. And then Anheuser, we've been selectively adding a bit to Anheuser. We think that there's decent margin recovery still to come through, and as they de-gear, that should benefit the bottom line in terms of earnings growth. And then if we look at our SA Inc. positioning, we've got a reasonable exposure there, which we've added to mainly via banks, and that's the likes of ABSA and FirstRand. And we've also got exposure to Sanlam and Momentum on the insurance side. And then selective exposure within SA Inc., which we've added to. We've had TFG in the portfolio for a while. We've added to Remgro, Bidvest, and Motus, shares that we feel are undervalued. And I think in a more positive environment, we think there's quite a bit of tailwinds for these shares. And then select resource exposure via Anglo American, Mondi, and Anglo Gold. If I just look at a snapshot of sort of from a sector perspective, what the portfolio looks like. So that global consumer name, that's about 30% of the portfolio, about 20% in banks. And then you can see that from a resource perspective, spread across the diversified resources, and a reasonable position in gold as well. And then spread across some of the other parts of the portfolio. And just touching on some of the key trades in the portfolio in the last quarter, as I mentioned earlier, we saw opportunities earlier on in the quarter, in the year, to top up in terms of FirstRand, Remgro, Woolworths, Momentum, and we funded that selling down some of the shares that had performed better, Naspers and Prosus, Nedbank, ABSA and Bidvest. If we look at the top 10 holdings of our portfolio, hasn't changed too much, and I've touched on many of these names, so it gives you a sense of where the top 10 positions are in the fund. And just touching on the outlook, I think, which is more important. So I think if you look at from an SA equity perspective, I think we've got a very supportive backdrop going forward, a lot more positive about the outlook given the removal of the election uncertainty and the government of national unity. I think it does create definitely a more robust, positive economic environment going forward. And I think it's important to point out that some of these initiatives had already gotten underway under Operation Vulindlela, but I think there's probably more traction to that going forward. On top of that, I think from a cyclical perspective, I think within the next 3 months to 2 years, I think we will probably go into a rate cutting cycle, which I think we'll all welcome. I think, we think that from September you start seeing rate cuts. That's the next meeting. I think the US will cut and we'll follow. And I think that gives you a nice backdrop. And then I think lower load shedding. I think we know that for over 100 days now we haven't had load shedding. I think that gives you, a more supportive environment. And I think some of the logistics constraints, I think those will start coming through. Those take a bit longer to come through, but I think you are seeing signs of them coming through. So just to show you a couple of slides on the backdrop, we know that, we came through the last 2-3 years, a period of severe load shedding, which was very debilitating and unsettling. For the last couple of months, we haven't had load shedding. And there's been, I think, rumors that we've been burning more diesel to get through elections. I'll show you that that's not the case, is what the numbers are showing. So we know that when we remove the caps on investment from the private sector into renewable energy, we saw a spike in solar PV installations, etc. And that's showed you on the chart. If you look at the spike last year, we saw a massive amount of investment going through, and some of those have started coming online. If we look at this slide, it shows you open cycle gas turbine generation, which is basically diesel, and you can see it's actually been quite low. So the reason for lower load shedding is actually the combination of solar PVs coming online, renewable energy coming online, as well as Eskom actually getting its act together. So we're seeing lower unplanned outages from Eskom's plants. And this line just shows you the energy availability factor. and you can see that we're actually on an improving trajectory here. So Eskom getting its act together on that side. And then lastly, just a chart on infrastructure and rail volumes and port delays. We know Transnet has been problematic, but we are seeing signs that things are starting to bottom with improved rail volumes, as well as the delays at the ports starting to ease. So we think that, with all of that, I think there's a lot of, the confidence has been low, and we can bounce quite quickly off those low levels, especially if corporates start to invest again. So you're getting all of that, and we think from a valuation perspective, yes, we have bounced off lows, but there's still a lot of upside, definitely relative to other emerging markets as well as developed markets. And if we look at an index, this is sort of a custom index that we do, which looks at the valuations of domestic shares. And you can see definitely we've had that bounce post the elections, but we're still trading at 1 standard deviation cheap to our history. So we still think there's a lot of upside. And of course, this doesn't take into account if we get earnings upgrades starting to come through in the next 2-3 years in a more positive economic environment. Thanks. I'll hand you back to Anil.